So the price in terms of the metals right now during this volatility, even though it may go down, should not be taken overtly seriously, because as part and parcel of this preservation of capital, the debt markets dying actually is turbo juice for gold and silver. Because those that hold the gold will still hold an asset, and those that held debt will watch it collapse in value immensely with the spiking in interest rates.
According to Francis Hunt, the recent drop in gold and silver isn't a sign of weakness. It's a temporary reaction to stress in the financial system. Funds are being forced to sell their winning positions, including precious metals, to cover losses in the collapsing private credit market, what many are calling today's version of a subprime crisis.
A lot of people that are in the precious metal markets are in far worse assets, such as potentially private credit, which is a fancy way of saying the new junk bond debt market, only worse because the issuers get to set the price. There's no exchange where supply and demand dynamics do that. And because of that, they're the market maker. It's not in their interest to market to the downside because that causes panic. And it means they are also marketing their own assets downside. And of course, many of them are banks. And they are also the liquidity provider if you want to exit. And they don't have the liquidity they need to deal with a stampede. So you've got the worst end of the credit market. And I put it in a category, it's subprime. It's the subprime of 2008. It is the junk bonds of 1980. It is the savings and loans garbage crisis of those 80s as well. So it is essentially the worst end of the debt and credit markets that is fraying and collapsing. And it is typically where you always start. You start on the most endangered debt, the most high-risk debt, and private credit is that. So what's happening is certain people might need liquidity and they will sell other things that have served them well. So the typical malaise of a trader is that they don't like to lock in losses because that means it's an acknowledgement, it's a mark to market, it's pain. So they actually cross-subsidize winning positions by selling good to cover and hodl bad. And it's a beginner rookies retail trader era when you are a trader, but it is also a line of action for highly committed funds that have high risk debt in the same space as they might have performing assets like gold. And sadly, to not acknowledge a loss and hope that it comes back means the original price still holds. So I don't know if you remember the scene in The Big Short with Michael Burry, but he'd given up chasing Goldman Sachs to admit that what he'd shorted had lost just about all its value. They kept insisting it was par, because they hadn't laid off the risk themselves yet. And only once they'd laid off the risk on AIG were they prepared to acknowledge the full devaluation of the subprime portfolio that he'd shorted. And he'd shorted the worst 3%. And there'd already been, 10, 15% in redundancies on debt. So he knew already that he was deep in the money and they weren't acknowledging. But they wouldn't let him short anymore. And they were trying to squeeze him out of margin because they were the counterparty until they laid that risk off.
Right.
So that's a perverse set of dynamics, and that's what you have in private credit that you were mentioning, which is why I say an HYG, a high yield ETF, at least you can panic sell. Yes, it will spill, but you can, and it's trades on an exchange, and there's buyers and sellers. It might not be very liquid. It might fall a lot on minor volume, but at least you can say, listen, I just absolutely want out at any price, and you can whale sell out of there. Private credit, you can't even do that. You're reliant on the person who created the asset to give you a fair price and to provide the liquidity for your exit. And what are they doing? They're restricting the degree you can leave. So they don't have the liquidity.
Are you curious about investing in gold and silver but feel held back by fear or confusion? This ebook is designed especially for new investors who want clarity, not complexity. It breaks down gold and silver trading strategies in a simple, practical way. No jargon, no hype. Why wait? Hurry up. Please visit this link to get your copy today and use code DUNDEEPLE for a huge discount. More than 1,000 people took the first step with this ebook, and today they're living proof that smart investing changes lives. Start investing fearlessly, wisely, and with a clear strategy. The system is quietly restricting how much liquidity can actually move. In simple terms, it's becoming harder for capital to flow freely, and that signals a deeper issue beneath the surface. What we're really looking at is the scale of the global fiat and debt problem. This isn't random, it's an engineered narrative, one that ultimately leads to even more debt, more currency creation, and eventually a breaking point. As this pressure builds, interest rates begin to rise, and at first glance, that seems negative for precious metals. After all, gold and silver don't generate yield, so higher rates can make them appear less attractive in the short term. But that's only the surface-level view. From a broader macro perspective, this environment is actually incredibly bullish for precious metals. What looks like a headwind in the beginning becomes a powerful tailwind over time. Think of it like a long jump. You have to take a few steps back before you can launch forward. That temporary pullback is what creates the momentum for a much bigger move ahead. And that's exactly the phase we're entering now. There will likely be volatility, uncertainty, and possibly even conflict along the way. But within that chaos, the foundation is being set for a significant shift, one that could strongly favor real, tangible assets like gold and silver.
I mean, my current favorite trade right now is, so we've been long gold aggressively and we're investors in gold, but we've also been leveraged traders in gold. We were fortunate to exit before the collapse, the slap in the face collapse that occurred on both gold and silver. And we've been waiting for a moment to get back in, and we've been entertaining ourselves with this particular market, and I'll show it to you. And this will, because you asked about a geopolitical event, I think this is the technical repercussions of a potential political event. Let me just show you this trade. It is, first of all, it's the dollar, and you might get a spike in dollar strength. So we are preparing for a spike in dollar strength.
Do like, share, comment, and subscribe to this channel. Also, don't forget to hit the bell icon for more updates.